please.
Yeah, thank you very much. Can you hear me all right? Hopefully. Well, thank you very much for coming today. This has been sort of culmination of quite a long project that's taken around 2 years and covered 5 different countries with fieldwork in each of the countries and workshops in them all as well. And the research generated both policy recommendations for each of those countries, detailed policy recommendations relating to the sectors we were focusing on, as well as broader conclusions around the role of competition in development. And it's mainly those that we'll focus on today, because there was a lot of material in the project, obviously, and we have limited time here, so we'll be focusing on that. Also, we'll only really sort of summarise some of the key findings or stories, I suppose, from each of the sectors. We don't really have time to go in any detail into the sort of analysis in those, but there's more detail in the reports which are now available online, and there's a summary report out there as well, which if you're interested you can read more about it. So just to start by giving brief sort of background on the methodology we were using and what we were looking at for this project. We were basically looking at 2 things. We were looking at the relationship between policy and the sort of market structure fundamentals in the country and the impact that has on competition. And then we were looking at the impact that competition has on market outcomes. So things we care about like prices and access to services, etc. So there were 3 sets of information we were trying to collect. We were looking at the policy context, which goes much wider than simply competition law and competition policy, to also look at things like trade policy, privatisation, state-owned enterprises, regulation, etc. It's a very wide set of policies that actually affect competition in the market. We were also looking at the market environment more generally and how that would affect the way that markets would work. And then we were looking at the degree of competition, and that looked at things like the number of players in the market, the degree of concentration, any competition concerns that were raised. And for that we used DFID's competition assessment framework, which was published a few years ago and which has a very nice sort of structure for analysing these issues. So we followed that framework to sort of draw some conclusions about how competitive each of these markets were. And then we looked at market outcomes. As I said, things we care about: prices, access to services, competitiveness on world markets, employment, innovation, those kinds of things, to see how the competitive environment within which firms operated affected their performance. And we did this same analysis for the 4 product markets in all 5 countries. So that's 20 lots of analysis. With a view to sort of drawing comparisons. So where one country does something very differently to another, what impact does that have on market outcomes? And we did find some really interesting comparisons and differences between the countries. So the countries we looked at were Bangladesh, Vietnam, Ghana, Kenya and Zambia. And the markets we looked at were sugar, cement, mobile telephony and beer. So they're both a wide range of both countries and product markets. And as I say, that was partly because we wanted to find these interesting comparisons. So we wanted to pick countries that had very different types of market structure. Also, we wanted to find interesting stories relating to different aspects of competition. So in sugar, the issue is very much about the role of the state in many countries, because they often intervene in the sugar market, state-led industry with lots of price intervention, etc., and the impact that has on competition in the market. In cement and beer, it's more about anti-competitive practices and the role of businesses and the way they behave, and that often causes problems in those sectors. And in the mobile telephony market, it's more about regulation and how that affects the sort of environment within which players operate. So they generated a range of different kinds of competition stories. And they're also, relatively important for development, most of them. Sugar is a source of rural livelihoods, and that's why government is often involved in it. Cement is important for infrastructure development, a big part of the procurement budget for some governments. Mobile telephony, there's lots of literature out there now about the role of mobile telephony in promoting development, etc. Beer, maybe not such an obvious link, but poor people do consume beer. It's a significant part of some budgets. So we thought that was interesting from the point of view of the competition issues that it's raised in many countries around the world. So that's just briefly the rationale for why we chose these countries and markets. Also to say that in terms of the level of development in competition authorities and law in the countries we focused on, they were very different as well. So Kenya and Zambia both have very well established and active competition authorities. Vietnam has recently, or mid-2000s, established a competition authority, although it's only really now in the last year or two starting to really engage and take action on problems that exist. And that's a very different kind of market environment they're operating in, as I'm sure you can understand, from Vietnam, which is still only really learning how to be a market economy. Bangladesh and Ghana, neither of which have a competition law or authority, both of which are in the process of discussing one and trying to set one up, although both have had huge delays in trying to establish a competition law, partly because of opposition from business and also political difficulties. So they're both grappling with these kinds of issues and looking for the evidence of how it might help them and what benefits it might have. So if I might just go through the sugar market and the beer market, and then hand over to Mr. Sampathilufia to comment, because I think both of those have particular relevance in the Zambian context. Before then, we hand over to Rohit to talk about the other markets, if that's okay. I think I've got enough time left. So, the sugar market, as I said, sugar is consumed by most people, including poor people. It's an input for other industries, such as confectionery companies, and it generates lots of rural jobs. Now, the markets in the different countries were very different, as this table shows. In Kenya, Vietnam, and Bangladesh, they had state-led sugar industries. And in Zambia, they had a private sector-led industry. And the difference in performance was really quite interesting. I mean, in all three of the state-led industries, they were basically on the verge of collapse or struggling to survive. They'd pretty much all been set up in order to create rural jobs. And they had done that, but in all cases, they were being very badly managed. They had inappropriate pricing. They were being forced often by government to price below the cost of production, which meant they were making losses, which meant they were unable to invest in machinery and remain up to date. So they were using obsolete machinery, which was very difficult for them to correct when it went wrong. They couldn't fix it. They were getting into huge debt. They weren't paying the farmers, and they were all being threatened by ongoing liberalisation processes and pressures. So in Kenya, for example, it's the COMESA arrangements, which are requiring further liberalisation of that sector, which basically threatens the future of that sector altogether and thousands of rural livelihoods as a result of it. To show a graphic illustration of what that actually means, this was a picture that we took in Kenya, and it doesn't do it justice because there was a whole long line of trucks waiting outside the state-owned sugar mill in Kenya, piled high with sugar cane that had been there for weeks because the mill had broken down. They couldn't fix it because it's obsolete machinery, and as a result all that sugar was perishing and the farmers weren't going to get paid for it. So that's having huge costs for that whole community. And if you look at the graph, you can see that Kenya is incredibly inefficient in comparison with Zambia, for example, in terms of the amount of sugar it actually produces per hectare of sugar cane that is being grown. So Kenya has a real problem, as do both Vietnam and Bangladesh. Zambia, on the other hand, has a private sector-led industry which is extremely efficient and has done very well traditionally out of export markets, selling to the EU under certain sort of trading arrangements that are in place, which have enabled it to expand production also in Zambia, and it's been building capacity and creating new jobs and really taking advantage of those opportunities. But the interesting thing about Zambia is that it competes internationally, and so it's very efficient internationally, but domestically it has no real competition, and so it prices very high. And you can see that Zambia has the highest prices of all the countries that we looked at. Now, partly that's for other reasons as well. Costs of doing business in Zambia are higher. Also, the other countries are somewhat subsidised. But there's also a large degree of that which is about the monopolistic structure in the Zambian market. So even though they're very competitive, they are still pricing very high, which is obviously not great for Zambian consumers. And the Zambian industry got together, a number of confectionery companies got together to make a complaint to the Zambian Competition Commission about this. They said the prices are very high and it's making us uncompetitive on world markets. And so the Zambian Competition Commission did investigate this and agreed that the prices were very high and recommended there be new entry or imports that would be allowed. But as I understand it, there's been still no movement from government on this. There's still high import barriers of different kinds, but one of them, for example, is that they require all sugar to be fortified with vitamin A, which is a very unusual requirement amongst countries, and so there's no one out there who's willing to export vitamin A fortified sugar just to the Zambian market. So it's a clever way of preventing imports. Well, that's what many people claimed in Zambia anyway. So they continue to have this monopoly, and one theory about this is that the reason the government won't tackle it is because it does very well out of it in many ways. It charges high tax. The company does a lot of CSR projects, spends a lot of money on roads, police stations, clinics, healthcare and education. And so the government has quite a nice relationship with this business, which may be why it's not willing to really sort of open it up to more competition going forward, even though that would clearly be in the better interests of the Zambian consumers and potentially also as employees going forward. So that's quite an interesting story relating to sugar, and both in terms of the role of private sector-led industries versus state-led industries, and the importance of having a competitive domestic environment in order to discipline the market. And then on beer, I won't say so much about beer. This is a picture which shows a lot more choice of beer than you get in most of these countries, because most of them have a very concentrated market. Beer is often a highly concentrated market everywhere because it tends to be dominated. Well, it's a business which has high marketing costs associated with brand, so it's very difficult for new players to break in. People are very sort of loyal to their own brand of beer that they like to drink, etc. So it's an interesting market. It's often very concentrated, and as a result often has anti-competitive practices. And in fact, in every single country, Bangladesh, by the way, doesn't have a beer industry, but in every single country there were anti-competitive practices that had been identified. For example, exclusive dealing, which is where the beer producer signs an agreement with the distributors and retailers to prevent them from selling anybody else's beer. So they all have these in place, and in the countries which have competition authorities, they've looked into it and done reports on it and imposed requirements and conditions on that activity by the beer producers. In the countries that don't have it, there's obviously no way to tackle that kind of problem. And for example, in Ghana, in fact, they have a duopoly. One of the beer producers took the other one to court for exactly this, exclusive dealing, and the court upheld their right to have an exclusive agreement in place. So they lost their case, and they were prevented from breaking into that part of the market. So it's interesting that if they'd had a competition law in place, a standard kind of competition law, the court probably would have ruled in the opposite direction. So that's quite an interesting example of the impact that a competition law can have. Within Vietnam, you had a very clear example of where there was a new player that tried to enter the market but failed because it couldn't get access to the distribution and retail parts because they had already signed agreements with the existing players. So again, a very clear example of how those kinds of anti-competitive practices can prevent new entry. The other story I wanted to mention on beer related to it's a part of a wider story about how multinationals operate across borders and how they tend to sort of carve up markets regionally amongst themselves. In Kenya, there was a monopolist, a Kenyan-owned monopolist for many years, and then a foreign-owned multinational tried to break in. There was this massive price war, prices fell dramatically, it became really sort of acrimonious, lots of nationalistic sentiment being stirred up by the incumbent, billboards were being slashed and knocked down, etc. So it got really quite aggressive. And in the end, the new entrant got out of the market, it gave up. But at the same time as doing that, it signed this share swap agreement with the incumbent, whereby it bought shares in the incumbent in that country. At the same time, the incumbent got out of Tanzania, and they bought shares in the other firm. So both firms had agreed not to compete directly in either country, and instead to have monopoly profits, which they would then share in by buying shares in each other, which is a very nice, neat solution for them. There's no law against that because it's cross-border, and so no national competition authority can tackle that kind of problem. So they were very open about it, and they talked about it on their website. They were very proud of it. It's great for their shareholders. So another interesting example of how this can happen, and it happens in other sectors too. We came across that kind of behaviour in relation to cement as well, and I think it's quite a widespread practice which needs to be tackled by regional competition bodies because national ones can't do it by themselves. So things like the COMESA competition body, which is being set up, and also SADC, could potentially tackle something like this. I think that's it on beer. So do we want to hand over to you?
Yeah, yeah, so we'll carry on with the other two markets fairly quickly. The cement market was an industry we also studied, and it's crucial for infrastructure development, which underpins growth in a lot of developing countries, and it's a significant proportion of a lot of government budgets as well for construction. So the price and availability of cement is quite imperative in many developing countries. And if you look at the table there, it shows you how, for our 5 case study countries, the market is structured. And you'll see a clear difference between the Asian countries and the African countries. The 3 African countries have 2 or 3 firms in each, and the Asian countries have 34 in Bangladesh and 90 in Vietnam. So there's a very clear difference. And in terms of market shares of the dominant firm, as you'd expect, the firms with, the countries with the least firms have more of a dominant player. So Kenya with 65% market share, the leading firm has, whereas in Zambia, the dominant player has 85%. Kenya has 3 firms, but interestingly, the dominant firm has ownership of the other 2, or part ownership of the other 2. So it obviously gives it a pretty strong degree of influence over the other firms, and it could result, or very likely to result, in reduced competition between the firms. And hence we've got that little silly photo of somebody with the fingers in all the pies, because that's what can happen, with that kind of anti-competitive arrangement. Zambia, which Mr. Sampa did talk about, I think, was a cement industry which was a monopoly created through the privatisation of a state monopoly back in 2001. And perhaps if there had been a competition authority at the time, that kind of anti-competitive move to retain a monopoly but just change the ownership could have been perhaps prevented. In Ghana, there are 2 firms, but it's essentially a duopoly with one following the price and kind of marketing style of the other. The Asian countries are very different. Vietnam has 90 firms, and the state owns 33 of them under an umbrella company. Vietnam's different in the sense that a lot of private enterprise doesn't exist in the way we'd see it in other countries. It's very state-dominated throughout the private sector there, and particularly in the cement industry, where the Ministry of Construction has very close links with the state-owned enterprises as well. So it's a very different structure. Bangladesh has 34 firms, and it seems to be quite competitive, actually. An important concept here is probably that of minimum efficient size. In cement, where there's a high ratio of fixed to variable costs, minimum efficient size is quite high. And this means basically the smallest amount of production you'd need to have to take advantage of economies of scale. And this is where in Asia, a number of the firms don't meet that kind of required efficient size. Only about 22% in Bangladesh and 21% in Vietnam have that kind of efficiency. In terms of price, there's a bit of a trade-off here, because although Vietnam and Bangladesh don't have many firms operating at minimum efficient size, they actually have the cheapest prices. So there's a trade-off between price and efficiency here. Zambia, which has the least competitive market structure, has the highest price by some margin. And there is a caveat to that, though, because the costs of doing business in Zambia, which is a landlocked country, is generally quite high relative to a country which is like Vietnam, which is coastal and has cheaper transport. So that needs to be taken into account. And also the African countries don't tend to have the main raw material, which is clinker, the limestone required as the input, whereas Vietnam clearly has a lot of limestone. If we look at the importance of competition, between 2007, when we actually did our study, and our recent visit to Zambia, there's been a dramatic fall in price. And that's mainly linked to a new privately owned plant that came in late 2009. So you'll see in all the other countries where there hasn't been any significant new entry, prices have gone up between 2007 and 2010, whereas in Zambia, the entry of one new firm and the prices have fallen. So in terms of cement, the kind of things we learnt about the market is that a large-scale operation tends to be more efficient, but in contradiction to that, countries with more players had lower prices, even though there was probably some inefficiency there. And the cement sector often suffers from anti-competitive problems. It's a homogeneous product. There can be cartelization, which is seen quite commonly across the world, and therefore it's an industry which competition authorities play an important role in providing discipline on the operators too. And in both Zambia and Kenya, it was seen that competition agencies did play an effective role in monitoring the sector. In Zambia, the ZCC placed undertakings on the cement monopolist to constrain its behaviour, and there was some evidence that that was having an impact. And in Kenya, although there is joint directorship of the three firms, there could have been even further consolidation with a merger of the two firms, which was blocked by the competition authorities. So it does show that competition authorities have been playing a good role there. Just like in the beer sector, there is an issue of regional problems in the cement sector as well, because there are many multinational firms that are massive and have presence all over the world, and that operate on a regional basis, where you can have elements of market sharing and profit sharing which go above and beyond the jurisdiction of domestic competition authorities. And in these cases, regional competition authorities are also quite important. And there's a COMESA Competition Commission, which is in the offing as well, which would help to resolve some of these kind of cross-border issues. The final of the four markets is the mobiles market, which is very different to the other three. It's the newest, very young, and it's evolving very, very fast. It's a market which is shown to have a lot of development benefits as well, in terms of business activity, in terms of just providing communications across the country and allowing economic transactions to take place, which just weren't happening prior to that. And it's also meant that because there's less requirement for fixed infrastructure and a lot of sunk costs, developing countries have been able to leapfrog the problems that fixed line technology had burdened them with. And what we're finding is that the mobile sector is facilitating job creation and also private sector development across the world. So. Competition in the sector, though, is very important, and we've seen that competition in all the countries has been driving growth and penetration, and also in reducing the prices or the tariffs. In most countries, we saw that when a new entrant came in, prices immediately started to fall. And an example of that is in Kenya, where two new entrants came in late 2008, and a previously very highly concentrated industry dominated by one firm then led to one with four firms and a real drastic drop in price, which we'll see in the next coming up slides. The other thing that competition in the mobile sector has done is it's created incentives to design services appropriate to the customers in that country, which in developing countries there's a lot of people who are on low incomes. And when there is competition, the companies tend to have to compete to try and attract those kind of poor consumers by packaging prepaid minutes in smaller quanta, and by offering off-peak minutes at various times and so on, and those kind of promotions to try and attract them, which was seen a lot less in countries where there was less competition. Telecoms, and we'll just go through some of the kind of metrics that we calculated. In terms of telecoms investment per inhabitant, this graph shows two red bars. One is for the sub-Saharan African average, and the other is for the Asia-Pacific average. And what you'll see there is Kenya has performed very well in terms of investment per head. We could only get 2006 reliable figures, unfortunately, but it was about $22.6 per head compared to Bangladesh, which was about 0.6. So there's a massive difference there. Kenya is one of the most concentrated markets up until recently, with the dominant player having had a market share of about 77%. This is in contrast to how much investment per inhabitant the country has. So perhaps there's some kind of link between a monopoly being able to spend more in terms of investment, but it's not something that we could conclude more broadly. It may be just an anomaly. And Bangladesh has the lowest levels of telecoms investment, but this may be because there's a very high population density in urban areas. So even though the penetration is higher than the investment would show for that reason. In terms of prices then, again we've got the two red bars for the Asia Pacific and Sub-Saharan African averages, and you'll see that the prices in Zambia and Kenya are substantially higher than Sub-Saharan Africa on the whole. In Zambia, that is partly related to a monopoly on the international gateway which had been there, because this distortion whereby international calls are very high has permeated into the domestic calls market, as private operators have had to subsidise their international calls in order to be competitive. And in Kenya, prices have also been quite high, but this has reduced somewhat with more appropriate regulation and the entrance with two new entrants. Vietnam, Bangladesh, most operators and the most competitive markets, the cheapest prices, so quite a clear link there. In mobiles, compared to the other three sectors, regulation is very important, as well as just monitoring anti-competitive practices. And some of the key aspects of regulation are those around tariffs. Tariff regulation is whereby if you have one person making a cross-network call, how much one company pays to the other company for connection of that call. And when tariffs are not, when that termination charge, as it's called, is not regulated, a dominant operator could charge exorbitant prices for termination charges, which effectively make a new entrant make it very difficult for a new entrant to increase its market share. There's also issues around infrastructure sharing in countries where infrastructure can be very expensive to roll out around the country, and a monopolist or a dominant company may have access to infrastructure which it doesn't want to share with others. It can cause the duplication of a lot of infrastructure, and government regulations in this regard can help to improve infrastructure sharing. Access to an international gateway can have a massive impact on prices for international incoming and outgoing calls, as has been seen in Zambia, where there is a monopoly, well, until recently, I believe, which has meant prices have been very high. And the final issue, primary issue anyway, in terms of regulation, is that of universal service. There are a number of countries where there are huge underserved populations because it's either not economically viable to roll out infrastructure and provide services to those areas, and also because consumers have much lower incomes in those areas. So government intervention may be required through licensing requirements or innovative funding schemes for the private sector to expand in such areas. An example is in Ghana, where we saw there's a fund called Giftel, which I think has changed its name now, where all mobile operators contribute 1% of their revenues to this fund, and then the funds are used by this agency to construct common telecoms infrastructure facilities in underserved areas, and then different companies bid through a kind of auction process to roll out their their technical infrastructure on those masts around the country. The scheme has been very successful, and 39 common telco facilities have been built, giving access to about 273 communities since it started in 2004. In terms of penetration, Ghana, which has some of the best regulations in terms of best practice, seems to have the highest penetration rates, and it also has one of the most competitive markets in terms of numbers of operators. If you look at Bangladesh, even though it has a number of operators, penetration is still low, and that's primarily because of non-urban areas not being covered so well, and perhaps regulation not being in line with best practice as seen in other countries. I think that's it. So, yeah, I'll leave it to you to do the conclusions.
Okay, so last two slides on the sort of broader conclusions from the study then. I mean, we, as I said, provided conclusions in relation to the specific sectors in specific countries as well. But in terms of the overall broad conclusions, I mean, it seemed fairly clear that competitive markets do tend to deliver better market outcomes, and that introduction of competition can have quite a sort of significant and immediate impacts, and we've given some examples of that. Even the threat of a new entrant can have a big impact on prices. Prices can fall significantly before any new entrant comes in, but in expectation of that, so they're going to try and stop them from gaining any market share. However, competition is often hugely hampered both by government policy and by practice by businesses. In fact, government policy is often the biggest issue in many sectors and countries. I think there's two sorts of reasons for that. One is it's sort of, just because governments don't necessarily understand the impact of their policies in terms of regulation, for example, and the fact that that may be undermining competition. And in which case you can tackle that through the introduction of regulatory impact assessment, through awareness raising by competition authorities, etc., as Mr. Chilufya was talking about. But the less innocent reason is that government, as we've been mentioning, often has a kind of vested interest along with business in keeping an industry protected or a firm protected. And there are all different reasons for that. Tax is one of them. State ownership is one of them. Private ownership by individual politicians is very common, or their family. Corrupt business deals, of course, also happen. And then there's the sort of CSRE type reasons as well. So there's a whole range of reasons why government may not want to introduce competition in certain markets, even though it would be in the best interests of the country as a whole. So there's clearly a problem there. I'll talk a bit more about that in the last slide. On industrial policy, we haven't had a chance to talk about this much, but industrial policy has been out of fashion for quite a while now. But in practice, most countries do it all the time, and probably need to, because this relationship between government and big business is so important that governments need to almost go out and court business to attract it into the country, because unless business knows it's got that support of government, it knows it's not going to survive. So I think there is a role for government to be quite proactive, and the question is how to do that. And in the past, industrial policy has often been done quite badly, resulting in protection and the big build-up of vested interests which oppose any kind of liberalisation going forward, which results in industries that don't perform very well. And so I think new ways need to be found that can promote industrial policy which is a bit more market friendly and more in line with competition, so that firms and industries can actually develop in a way that can be successful on world markets, etc., going forward. So I think there's a big piece of work needing to be done on that. Talking a bit more then on the last slide about this link between government and business, this creates really strong vested interests opposed to any kind of pro-competition reform. And I think that even goes beyond that, and I would say that it prevents a lot of growth policies from being adopted. We often know how to promote growth in countries, it's just that we can't get that implemented, and the government won't implement it because of these vested interests, who are doing very well out of this sort of elite arrangement that they have with a set group of people in a country. So I think we really need to find a way to tackle that elite problem. And one of the ways to do that we've really sort of come across through this work is to build a constituency in favour of reform. And so that might include both consumers, household consumers, also industrial consumers who do better out of cheaper priced inputs, also potential new entrants into industries that are opened up. So you can build up a constituency in favour of reform that can help to tackle these vested interests opposed to reform. And here I think competition authorities can really help by providing the evidence base on which to build up those kinds of constituencies and mobilise those groups. They can also help to build this culture of competition, as Mr. Chilufya was talking about, raising awareness and understanding, publicising reports in the media, etc. And where they do face a lot of barriers to tackling competition problems because of the role of the government, as we've discussed, it can be best perhaps for them to focus on building the evidence base and promoting competition solutions within government, from the inside, rather than trying to tackle it through the courts, which often creates all sorts of problems, both political and logistical, given how slow court cases take in many developing countries. So that's very quickly the sorts of conclusions that we drew. There's a lot more detail in the reports which are available, and I did another opinion piece on this whole issue about the link between government and big business, if you're interested in that particular issue, all of which are outside.